All right, let's talk about the Wealth Score funding matrix. And what this is a protocol that we like to follow in the Wealth Score system to give us some idea why a bank or lending institution will not afford us credit, a line of credit, credit cards, all right, or a specific credit facility. All right, essentially, these are 25 blocks that I've created to give us some guidelines to follow. Too many inquiries is in the first block. And essentially, you could have a 750 credit score and have almost everything else in the Wealth Score funding matrix positive, and be declined for a corporate credit facility or personal loans, or even a personal credit card for that matter, or a business credit card for that matter. All right, so I was applying for a Blackcard and I was declined with 800 credit scores, perfect, positive Wealth Score funding matrix characteristics, and was declined because I had more than two inquiries. So too many inquiries could affect your approval for personal funding or business funding. Secondly, high debt to income ratio. Okay. If you have too much debt in comparison to your income, you could be declined for funding, whether it's personal or business. Limited credit history. The average time that you've had an account open for your personal credit profile, all right, if it's less than what a bank underwriting guidelines are, say for instance, their guidelines is they're looking for someone that has 7 years of credit history, all right, that could be a reason why you're declined if your credit history is less than 7 years. All right, typically bankers or lending institutions or credit card issuers do not say how much credit history you need, but sometimes you'll see in the declination letters limited credit history as one of the reasons why you were declined. We all know that limited employment history could get you declined for personal or business credit. Typically, 2 years is the threshold for employment history. Many mortgage companies require 2 years tax returns. All right, so that's symbolic of you need to be on the job for 2 years. All right, so you got to make sure you know that you have the right amount of employment history for the specific credit facility for a business or personal credit facilities. Limited credit references. Now, what this means is you could have a thin file. And many people in business say a thin file. What that means is you don't have a lot of trade lines. Okay. Typically in business, you're looking to have you want to have between 7 to 10 trade lines. They call those pay experiences before you start applying for loans, business loans for capital. All right. You can have, let's say, 6 or 7 pay experiences that are 30-day payment cycles. Okay. Those pay experiences will then evolve you to getting revolving pay experiences, which are credit cards. And then the mix of pay experiences, the 30-day cycles with the revolving cycle, typically you can then start applying for business lines of credit or business loans. All right. Now on the personal side, you can have as few as 3 to 5 credit references. All right. Depending on what type of credit facility you're applying for. If you're applying for a credit card, you could have 3 to 5 pay experiences and get new credit cards. But if you're applying for a personal loan, you might need more pay experiences or credit references with some collateral. Too many open loans can get you declined for credit because they believe you have too much credit. Okay. So if you have too much credit, then there's a risk that you're overextended. All right. So on the personal side, I know that is really something that banks and lending institutions look at, how many open loans you have. On the business funding side, in most cases, you can get away with a little bit more room to have more credit facilities for a business than you can do for a personal credit profile. High risk employment industry. Now, this is something that many people don't talk about in the lending and banking institution, but there is a job security score where you can determine based on a questionnaire that you're given if you're in a high risk employment industry. So job security score will determine if you're in a high risk employment industry. So you want to know that. So that's a part of the wealth score system. We talk and teach on the job security score. High risk business industry. Now, this is so important. I can't stress this enough that you must know what banking and lending institutions, they have a list of high risk business industries that they do not like to lend to. All right. And the way they determine what industry you're in is based on your NAIC or your SIC codes. Okay. And typically these are the codes that are provided by the Business License Bureau, wherever you have, what state you have your business is and what their license bureau has categorized you as. And they report this information to the state. And then the state in turn reports this information to the government, and they classify you with these industry codes. But as a personal note, you should be very aware of what your accountant or what your bookkeeper is putting on your tax returns, because there's a place, a category there to add your NAIC or your SIC codes for your business. All right. So you want to make sure that if they're reporting that for you, that they're reporting the accurate codes. I can't tell you how many times I have seen clients and myself apply for business loans and find that the bank declined the loan based on the NAIC or the SIC codes that they had in the database. So make sure you check Dun & Bradstreet, see what they have for you, Equifax Business, Smart Business, and Experience Smart Business, and Equifax Business Scoring. All right, so that's Dun & Bradstreet, Equifax Smart Business, and Experian. Okay, check those to also see what NAIC and SIC codes they're reporting. Errors in your consumer file data. Okay, we have over 70 plus consumer files. And remember, these consumer files are data that's collected by private organizations, and they sell this information to credit bureaus, banking institutions, lending institutions, auto dealers, right? And this is information that's not included in your credit report, your consumer report, or typically your business reports. All right. These are consumer files. These are the equivalent of a private investigator's data report collected on a private citizen. You can't find that data unless you know who that private investigator is. So you can't find your consumer file data unless you know who's reporting it. So you have to know the names of the consumer file or the data reporting companies. Next is insufficient collateral. Of course, we understand that if a bank is looking for collateral to determine the underwriting of a loan, whether it be a personal or a business loan, if you have insufficient collateral, of course, the bank will decline you for credit for that matter. Insufficient banking reserves. All right. We all know that you can apply for a mortgage and be potentially stipulated that you must have a certain amount of reserves in your bank account in order to have that loan funded or approved. All right. The same thing happens for businesses. There is a banking rates that businesses get based on the amount of their average bank account balance. All right. So they're scored on that. All right. And that is considered insufficient banking reserves. If that bank rate is less then the score is, if that score, is less than what's required to get you approved, meaning your average balance in your business bank account is lower than what's required for that loan to be approved, you will be declined. Okay, so banking reserves play a major role in being approved. All right, limited business payment experiences. What that means is, let's say you're applying for a $100,000 loan, okay, and you don't have a pay experience close to $100,000, and the bank requires a pay experience equal or less than by a certain percentage of the 100,000 that you're applying for, and you don't meet that guideline. Of course, then you'll be declined for $100,000. But typically, you're not sure what amount you will be approved for, because bankers don't steer you or advise you. They just allow you to apply, and they give you sometimes some advice, but not the complete underwriting guidelines that they follow. So you must have business payment experiences, okay? And that is the same thing that Dun & Bradstreet speaks of for the business. They call it the PAYDEX, your pay experiences. Sometimes you have to have a number of pay experiences, which are trade lines, all right? And we talked about that a few minutes ago, where we talked about there's a certain amount of trade lines you need to not have a thin file, okay? For businesses, you have to have at least, I would say, anywhere between 3 and 8, but it varies. A lot of pundits in this industry will tell you, 5 to 10, but it just depends on what you're applying for that will dictate how many pay experiences you have. Insufficient bank account history, okay? Many people thought back in 2006, 2007, that you could buy a seasoned corporation that was 5 years seasoned, and you could go to the bank and apply because you would meet the typical guideline of 2 years seasoned business to apply for business credit. Well, then there was a shift, I believe, somewhere around 2008 or 2009, where bankers started looking at the bank account inception date. When was the bank account opened? And they started using that as the seasoning date. So sometimes you can have a business that's been open for more than 2 years, but a bank account that's not been open for more than 2 years, and you be declined because insufficient bank account history. Lack of income or unavailable tax filings. All right. Sometimes you can have too little income. All right. And you're applying for a loan where the income guidelines, you don't meet that guideline. All right. And then sometimes as business owners, you can apply for a loan, have the right amount of income or revenue, I should say, but you don't have the proper tax filings. Okay. Sometimes business owners can file their taxes where they mitigate or accept the least amount of personal income to mitigate their taxes, but they have a high business revenue, but because they pay very little taxes by accepting less income, it looks as if they don't have enough or they lack income, and so they will be declined for certain loans or certain corporate funding. All right, because in many cases you have to become a guarantor, but we try not to be a guarantor behind the business or for your business. But if you have to, your personal tax filings and your business tax filings will be reviewed. Sometimes those tax filings have been extended and you're applying for a corporate loan or a personal loan and you haven't filed because you filed an extension with the IRS. So you will potentially be declined because of your unavailable tax filings. All right. Outstanding tax liabilities. Sometimes you have a payment arrangement with the IRS for outstanding tax liabilities. And because of that, if a business or a bank or a lending institution or a mortgage company requests your tax filings through a 4506, which is a document they have you execute so they can request your account record with or account history with the IRS. If you have outstanding tax liabilities, even though you're making payments, that could cause you to not be approved for a personal loan or a corporate loan in many cases. Unavailable corporate documents. I can't tell you how important it is to have all of the corporate documents that a bank or lending institution requires in order to review your application for a loan. In many cases, you're going to need your corporate charter. Okay. You're going to need your business licenses. Okay. Your state licenses. Okay. They require different documents, but once they ask for those documents, you need to have those available so you can submit them with your loan. If you don't have them available, of course, in many cases, you're going to be declined for the corporate facility. Improper codes. Now, we talked about this earlier, the improper NAIC and SIC codes. Okay. Now, we talked about some being high risk earlier, but now I want to talk about how you could have the wrong code for your business, and you could note on your application that you may be a real estate company, but your NAIC or SIC code may say that you're a property management company. All right. One, you're selling real estate, and one, you're managing someone else's property. So that could be a reason why you would be declined for a loan, the improper NAIC and SIC codes. Now, this is an interesting one. Negative business, social media, and reviews. All right. Lending institutions and bankers are reviewing your social media and your reviews when they do research where your company is located. They may do a Google search to make sure your address is showing up in Google and your phone number is showing up to be the actual phone number and address you placed on an application. And in doing that, of course, in your organic search results, you're going to have your social media results post as well. And so I have seen on some applications for credit that bankers and lending institutions say because of your social media and your reviews, you are declined for a loan. All right. So make sure that that is accurate. Also, make sure that when you someone calls 411 and tries to locate your phone number and address through 411 services, that the address and the location where you are is the correct address and location that is being given on 411 calls. Okay, that's very important. Now, a low FICO liquid credit score. Okay, now many people don't know that FICO has a liquid credit score for small businesses. All right, and this is something that they have joined with Experian for your personal, and then also for the business, the liquid credit score. So it's a blend of the personal and business scoring. And typically the industry standard is you should have over a 160 score. Okay. The Small Business Administration is really keen on looking at your liquid credit score. Okay. So check and make sure that you have a liquid credit score above 160. Now, of course, we all know that you want to have high credit scores, because a low credit score, of course, depending on which banking institution or lending institution you're contacting, everyone has their own guidelines, but across the board, a low credit score will get you declined potentially for a loan. I believe between 680 and 720. I like 720 better. At that score, you could potentially get approved for a high rate of your personal and business credit applications. All right. So monitor your score. Make sure you're 680 or somewhere above 620. I prefer. All right. Now, low Dun and Bradstreet, Equifax, or Experian business scores. Okay. Typically, if you have low business scores for business credit, you will be declined. The Dun and Bradstreet, the industry standard, is an 80. All right, Paydex score. Now that Paydex score goes from 0 to 100. Okay, just as the Equifax and Experian, and somewhere around 80 or above is a safe business score. Okay, so you can check these scores online. You can go to Dun and Bradstreet. You can go to Equifax and Experian to find out what your business scores are. And of course, we just talked about low personal credit scores. And of course, that's Equifax, Experian, and TransUnion. Now, check systems report. Okay, now this is key as well, because you could have a low wealth score. All right. And of course, this is a score that's not monitored or not known by very many. So they don't know, private citizens don't know where to go to get this score. Okay. This score goes from 1 to 6. Okay. 3 being an average, anything above, anything around 3, 4, 5, or 6, depending on the banking or the guidelines of the loan provider or the credit facility. You could be declined if you're, lower than a 3. All right. So we want to focus on your wealth score. Okay. Now, early warning services report. Now, this is an amazing piece of information when you actually get your early warning services report. This is a company that's been around for 20 plus years, and they help bankers mitigate their risk when they're doing loans. But the key to this company is not that they're working on behalf of the banks to mitigate risk, and the data that they collect is designed to prevent fraud. All right. But what I have learned is they actually share the information that they collect on consumers with regards to their debits and credits in their personal accounts, and their deposits and withdrawals, and when they're overdrawn. All right. And this is scary, that you could get a copy of this early warning services report and see years of your debits and credits and your deposits, and see that there's a section where other banking institutions have inquired about your debits or your banking activity report, and early warning services will supply them with that data. So if you carry very low balances and you're overdrawing your account a lot, then if you're applying for business credit or personal credit, and you're the guarantor for the business credit, and of course you're the guarantor for the personal credit, and the lending institution requests your early warning services report, your low banking reserves, okay, insufficient banking reserves, again comes into play, and you could be declined for this or for that loan and not know it was because of your early warning services report. Okay, you could have had 720 credit score, been in the bureaus for 20 years, had good business social reviews, good business social media, the proper NAIC code, proper corporate documents, all right, sufficient collateral, all right. You could still be declined because of the banking activity that is noted in your early warning services report. Okay, now, open or closed public records. Sometimes you could have a bankruptcy that was discharged, or a tax lien that was paid in full, okay, or a judgment that was paid in full. But these public records, in many cases, if that is not on your credit report, many times you'll find it in your consumer files. One of them, particularly LexisNexis, keeps or collects public record data. This could cause you to be declined because many banks don't like or won't approve a loan with someone that has open or closed public records. Now, the lack of equivalent trade line or low high credit. Okay, so on a personal credit report or profile, you'll have the high credit, all right, which is the highest amount of credit someone received. Now, if you're applying for something equal or greater than your high credit on your credit report, it's a high chance that you will not get approved for that, okay? Because typically that means the bank is approving the maximum that you've ever had as a pay experience. And in many cases, that to them is a high risk. So they won't approve you for that amount. All right. So you must have a equivalent trade line for most bankers to just say, we will approve close to your highest credit limit or highest credit experience. But we typically will not match that. That's what I've seen in the industry for bankers. Okay. So this is the Wealth Score funding matrix. All right. So this is what we want to consult. And also we want to consult the declination letter that we receive typically if you're declined for credit, and see if what they have listed in that declination letter, if that is what you will see also here on the Wealth Score funding matrix. And this is the way you can narrow down why you were declined. I like to review those letters and then reapply after I've corrected the list of things that they said were the reasons why I was declined. Okay. But for now, the Wealth Score funding matrix should give us a roadmap. And we want to consult this before we apply. So we're not getting declined for no reason if we could have prevented that. All right. So again, this is the Wealth Score funding matrix.